Hello and welcome. My name is Joe O'Mara. I'm the head of aviation finance with KPMG. And on behalf of KPMG and Airline Economics, I'm delighted to be joined by Austin Wiley, the CEO of SKY Leasing. Austin, thanks again for joining us for the purposes of our Aviation Leaders Report 2022. I should say we're recording this 5 days before Christmas, so people will know what's current. Can I ask, before we get into the meat of the questions, why don't you tell our watchers, a lot of whom will know, a little bit about SKY Leasing?
Sure. Sky is an alternative asset manager. We focus on new and young midlife aircraft, and we have a series of funds that are backed by institutional investors globally. Today, the fleet is around $2.5 billion in size, and we're looking to grow that by about $1 billion to $1.5 billion per year.
Good stuff, Austin. And obviously, when we spoke last year, you guys were nearly riding a wave of positivity in that you hadn't deployed a lot of capital pre the distress hitting. And we're really taking up some interesting opportunities that having that cash and being able to help airline customers opened up to you. How have you found customer performance evolve over 2022? And what kind of opportunities has the crisis thrown out for you guys?
Yeah, I think as you described it, we were fortunate to be able to really select the airlines and the opportunities we wanted to pursue without much of a legacy fleet pre-COVID. And our thesis remained the same at the time, which was airlines with large domestic markets, airlines with exposure to short haul and leisure traffic were going to perform the best during this crisis and ultimately recover the quickest. And in 2021, we've largely seen that play out. And so the performance of our airline customers has done really well. We continue to see great opportunities with that customer base and have actively expanded our customer base this year, particularly in Latin America, where we've been able to partner with a number of airlines there as part of their restructuring process coming out of bankruptcy.
And that opportunity side around customers, is it still coming back to fundamentals around the airline, or do you have a particular geographic focus? You've spoken of Latin America. Do you have go-to or avoiding areas, or again, does it come back to airline-specific analysis?
Yeah, I think where we're cautious right now is around airlines that are operating in countries with zero COVID restrictions or effectively zero COVID restrictions. We've seen that have a dramatic impact on airline operations. But where airlines and governments are more cooperative in allowing a kind of testing procedure that works for passengers and airlines to allow the free movement of people, we've been able to pursue those types of opportunities. So we've done business in Iceland this year, 737 MAXs. That's a country obviously with very little domestic market. So we're not exclusively focused on just large domestic markets. Where we believe in the management team, the fleet process that they're undergoing, and the capital base behind them, we're happy to back airlines even if they have exposure to, or a significant amount of exposure to, long haul or international travel.
And on the leasing side more generally, as a market perspective, we've talked for a long time about breaching the 50% in number of aircraft, and it's pretty clear we're probably above that now. You look at what lessors have funded over the last 12 or 18 months, to probably near 60% of new deliveries. Do you think that step change is sustainable in leasing as a popular source of finance? And do you think there's a ceiling or threshold on what that percentage will go to?
I think it's been incremental change, as you describe. I don't think it's necessarily foretelling that it's going to march up to 60% in any time in the near future. I think lessors have been able to basically take market share from the bank debt market, where we have seen a meaningful pullback of capital. But largely, I think around the 50% level is the right level for the overall industry and for airlines in general.
And the space you've played in has been, the narrow-body new tech space, the most popular space to be in. How have you found it from a competition perspective around pricing? And anecdotally, it seemed at the outset of COVID, there was a bit of a bounce, and that's kind of been pulled back. How have you found it?
Yeah, look, the market is reacting to the supply and demand dynamics that we're dealing with right now, which is, both manufacturers are producing significantly below pre-COVID levels. Boeing probably around 35-40% of pre-COVID levels, pre-MAX grounding levels, and Airbus closer to around 2/3 pre-COVID levels. So that's a meaningful amount of supply that's not in the market today, with essentially the same or potentially even more dollars chasing those deliveries. So, it's natural that there would be pressure on pricing as a result of that. I will say everybody has benefited from incredibly low or historically low borrowing rates. And so spreads still remain healthy as a result of that. And the quality of the airlines that continue to take aircraft has to be taken into consideration, which is the airlines that have continued to pay during COVID have proven how creditworthy they are, and should get credit for better pricing in general. So in our view, the issues around low lease rate factors will probably get resolved over the next 12 to 18 months, because both the manufacturers are increasing their production rates, and that will naturally bring more supply, more opportunities in the market, and create a more better supply demand dynamic.
You mentioned interest rates there. It's probably broadly expected that we're going to move into some hikes. I think the Fed's talking about 3 jumps over the course of 22. As a lessor, what do you think about that type of environment that's coming down the tracks?
I would say it's nothing we haven't seen before. We saw rates rise between 2015 and 2018, and there was still a very robust market, both primarily origination sale-leaseback and secondary market, including M&A. And so largely, lessors know how to deal with interest rate exposure. You can share that exposure with your airline customers. There's tools to do that. There's ways to hedge. And so from a rising rates perspective, this is a known challenge for lessors. We've been able to manage it in the past, and I don't see it significantly derailing business models over the next 12 to 24 months.
And on the debt market side, you mentioned lessors, some of the market share is filling that gap. And we did see a retrenchment probably last year from traditional aviation banks. Where do you see that market currently sitting? Do you think it's come back in a real way? And interested in your thoughts on the kind of non-traditional lending platforms that have sprouted up over the last 18 months.
Yeah, certainly we've seen a significant uptick in alternative lenders coming into the market. I think it's natural. They're trying to fill the void of the traditional bank lenders who have pulled out either for regulatory reasons or just for risk management reasons. And they have provided a nice product, a nice complement to what the capital markets or what the unsecured market has to offer. We're early innings in what the alternative asset managers and alternative lenders can do. I think the product is a bit narrow today, relative to where it will be 3 and 5 years down the road. And certainly when we talk to our institutional investors, there's an increasing interest in playing in multiple parts of the capital stack. And that's what's exciting to us, is can we provide potentially solutions down the road where investors are investing not just in the equity, but in different parts of the capital stack, and effectively allowed to tranche these transactions within their portfolio.
So having situations, as you say, where if we take an ABS example for that, you're playing in the A's, the B's, some of the C's, and potentially the E's, and you're trying to allocate that on an investor by investor basis.
Yeah, that's right. I think ultimately we'll see more and more large institutional investors approach it like that. And that market is where the demand is as well. And that's one of the reasons why we've seen, the significant ABS issuance that we've seen this year. So, we see this continuing to grow. This is a long-term structural change away from the balance sheet banks, traditional transportation banks, into private institutional hands, just because there's not enough fixed income product relative to what they need to meet their investor requirements.
And on specifically ABS, I think some of the theme and the discussions we're having forward is the surprise at how strongly it came back. Obviously, we're not there yet on tradable E-notes, but if you'd asked people 12 months ago, will you see a dozen ABS transactions in 21? Not uniformly, but most would say no. Having been through the experience on SLAM and achieved a really good result in relation to the rate that was there, were you surprised at the rate you were able to achieve from the ABS transaction and just the level of interest and appetite you got? Talk to us a little bit about that.
Yeah, I mean, we were very happy with the results. I think based on market sounding that we did in the first quarter, we saw a very significant demand for well-constructed portfolios. And I would say post-COVID, that's the biggest change that we've seen, which is investors are differentiating on the quality of the portfolio in terms of the pricing. And even with the same manager, bringing different portfolios to market, we're seeing differentiation in that pricing. And I think that's a really healthy result. It's going to allow for more market participants to choose what kind of risks and they're willing to take within these ABS structures. And so, frankly, we're not surprised. We saw a shortfall in kind of supply of ABS globally across different sectors. And we knew aviation being close to 10 billion pre-COVID, there was going to be a demand for that to come back. And so we see that continuing next year, probably about the same amount of volume, maybe slightly more. And what would really shift that would be a return of tradable E-notes or equity sales, where lessors using it as a sale tool would look to tap that market, which they haven't really in 2021.
And did you see, obviously you've been down the ABS route in SKY's previous iteration, were there significant structural changes between, you look at maybe S-Jets versus SLAM, or is it just tweaks to maybe bring investors, back to the pool?
Yeah, frankly, I think it's just tweaks. I think it really comes down to investors want to hear our thesis, why these assets, why these credits, why did we come with this specific pool of assets? And that's more important to these investors than enhanced structural features, that are frankly really backward looking and not all that helpful really in our view in terms of de-risking a portfolio.
And can I ask you, probably segues in on the investor side, have you seen any trends pre-post COVID on the types of investors coming? Or is it still, I say, the classic US private equity, Japanese capital, institutional investors? Any interesting tweaks that you've seen over the last 20 months or so with the types of people looking to invest in aviation?
I would say we've seen more interest out of infrastructure capital, and certainly kind of credit funds have been a big source of capital. So these are guys that would typically play in liquid credit products. And because of the compression they've seen in that market, they've gone increasingly into less liquid or tradable products like aircraft leasing to generate the returns they need for their investors. And so, they seem to be here to stay. That was obviously a trend we saw pre-COVID. We've seen an increase post-COVID. And we've seen other pockets of capital like infrastructure funds, also Stone Peak coming in with the loans, buying the aviation loans earlier this year. And so, largely I think aircraft continue to perform really well from, we've experienced probably the biggest dislocation that we'll ever see in this industry. And the assets and credits that people expected to perform well and recover have. And so it's natural that we would see increased demand for those high quality assets and high quality airlines.
And then maybe moving back to the broader leasing space, we saw at the outset of 21, the AerCap supersize consolidator, and we saw some kind of smaller pockety M&A that happened. We're coming to the end of the year and there's lots in the rumor mill, right? We'll see what comes through in Q1. Your thoughts on us seeing more material consolidation over the course of 2022?
Yeah, I think when you think about M&A, it's really driven by the shareholders and what their long-term plans are for these businesses. And then you have several macro forces driving what the buyers are trying to achieve as a part of these M&A processes. And so when you look back at 2021, you had abundant liquidity, very low interest rates, and a relatively less organic growth opportunities because both manufacturers had reduced supply. It's natural that shareholders and lessors looking to grow beyond the organic growth opportunities would want to participate in M&A. And when I look at both the rumored M&A processes and some of the M&A processes that have closed, they were generally driven by the sellers wanting to exit that business or not wanting to participate long-term in the business. And so I'm not surprised that the names that we hear in the market may potentially have an M&A process or a sale process early next year. I'm more surprised, frankly, that buyers or the price that buyers are willing to pay are interesting to the sellers. And what time will tell will be, are those prices appropriate for the risks they're taking on those portfolios, or is it largely driven by a pressure to deploy capital or take advantage of low interest rates?
And that element around scale, and obviously the AerCap one's an outlier, but you now have this three times as big as the number two player in the market. Do you think that might drive, say, top 10, and maybe some of those IG lessors into thinking that increased scale is relevant? And yourselves as an asset manager who are bringing equity in and putting pools of assets in different buckets, how do you think that impacts you, or does it impact your plans?
Yeah, I think scale is important when dealing with the airlines, and that typically the transaction sizes are anywhere from 5 to 10 aircraft. And we are able to transact in that size. We have done that this year. We announced doing 10 A320neos with LATAM, delivering over the course of the next couple of years. So yes, there is a certain minimum scale to participating in these sale leasebacks. I don't think you need to be in the double-digit billions in size to do that scale. And I think there is probably some risk in that the airlines don't want to be overly reliant on any one lessor if they need to restructure, if they need help. And so if anything, what we've seen over the last 3 to 5 years is more leasing companies come into the market, more platforms emerge rather than less. And really it's because we've seen more specialization, more differentiation in what the lessors are targeting, what their investors want in terms of the return, and frankly, how they add value in a given transaction. And so I think naturally the consolidation like AerCap and GCAS will force some reflection amongst the top 10 or top 20 lessors. But I don't think that we should expect necessarily that there's going to be a material amount of consolidation, because when you look at the shareholders across the top 20 lessors, they're very stable, they're happy with their businesses, and it doesn't seem like there's a need to grow beyond necessarily what organically is available in the market.
Yeah, I think that's fair. It's tough as you read down the list to guess who's going to be bought next. It doesn't particularly jump out at you. Can I ask you, this could be a short answer being narrow-body new tech, but from a metal perspective, and when you look at it, that has been your focus to date, and that's clearly very logical. Are there other pockets that would interest you as investable metal?
Yeah, I will say, look, there's been a lot of negative reaction and negative views on wide-body aircraft over the last 12 to 18 months. I think we would acknowledge, and the industry acknowledges, that international travel will take longer to recover. With that said, the 350, the 787-9, the A330neo are fantastic aircraft. They're early in their production cycles. There's no replacement technology for those aircraft. And so we continue to invest in long haul. We see an opportunity there to invest, even though there is still risk about the recovery period related to long haul travel. And so, that is a market that we've played in this year that we expect to continue to pursue next year. And we've also selectively looked at the A220 over the last 12 to 24 months as an opportunity aircraft that should continue to grow. And really, when you look at the 320neo production line largely being sold out for the next 5 years, if airlines want next generation narrow body aircraft, the flex from the manufacturers really comes from the 220 side. And so I expect there'll be more operators looking at the 220, more lessors considering financing that 220, which will naturally be healthy for that market. So that's a market that we continue to evaluate, though haven't invested in directly yet.
And on the manufacturer side, if we posit that leasing will be, nearer maybe 60 than 50%, there's just more interaction on the OEM lessor side. What are your thoughts on how that percentage will be managed? Is it still 30% of a small number of large lessors with order books and the rest is sale and leaseback? Or do you see the pandemic in any way giving rise to a step change in lessors with order books?
I think the airlines are careful to, or excuse me, the OEMs are careful to manage the order book percentage to lessors, because lessors are typically placing those aircraft 12 to 24 months ahead of those deliveries. And if you have dislocation like we've experienced over the last 24 months, it's very difficult for the lessors to place those aircraft. And that creates pressure on values ultimately, and pressure on lease rates, which affects the demand for that aircraft type. And so I think the OEMs will want to continue to keep that around that 25 to 30% level. Boeing has done a good job of rebalancing that on the MAX side. And frankly, we've seen a very significant uptick in values and lease rates for 737 MAXs in the last 6 months because of the hard work they've done in rebalancing that order book. In terms of order book in general, I think lessors will continue to want to have that as a tool in their toolkit. It can make sense in certain cases. The question we have to ask ourselves is, how relevant are we to the OEMs? How much does the OEM need additional orders from a lessor? In the case of an Airbus right now, their order book is sold out for 5+ years. It's very difficult for us to say we're going to be able to create value there when Airbus isn't really feeling a strong demand to want to sell into that lessor channel. So what we've seen obviously is more lessors pivoting towards MAXs, and that really is a reflection of Boeing probably needing the lessor community more so than Airbus at the moment.
And to touch briefly on one topic that is an existential crisis for the world, and by extension will have a big impact on aviation, which is climate change and ESG, but maybe coming at that kind of narrowly, right? We know there's ambitious targets, we know there's building blocks to get there. Curious, as an asset manager growing a fleet aggressively, at the moment, is the ESG agenda having a real impact on your business on a day-to-day basis, whether on the debt side or the investor side? Clearly, your asset picks are the best you can get, right, from an ESG perspective, but very curious on that investor and debt interaction piece.
Yeah, I think it would be foolhardy not to expect a step change in terms of what investors require in terms of ESG. So we've seen a sea change over the last 6 months in terms of investors wanting to understand our policies more, wanting to understand how this industry is going to transition from carbon emissions to zero emissions over the next 30 years. And we are making those plans ourselves. But the question I have, and the question that I think most industry participants have, is really who is going to pay for this transition, right? How long will it take for passengers to be willing to pay for the incremental costs that it takes to transition to a sustainable aviation fuel? Somebody told me an analogy recently, which I think is appropriate for how we should consider the step change in aviation, which is, investor or customers are willing to buy, locally produced, sustainably produced food, locally produced, sustainably produced clothes. If we can educate our customers about the benefits of sustainable aviation fuel, potentially they will be able to pay that premium. But right now, customers really aren't willing to pay for that incremental cost that it takes to implement some of these tools for transition to zero emissions.
Yeah, and I think that's an interesting point, and particularly when you think messaging is going to become so important here, about the good things are being done, as you say, getting buy-in. Austin, in closing, as we've come through, as you say, probably the biggest market dislocation, hopefully we're ever going to face. We feel we're on the up, right? Variants accepted, right, are going to have bumps along the road. But what do your optimism levels look like as you think out into 2022? What are your hopes and what are your expectations?
Yeah, I mean, I'm very optimistic about the airlines that have used this crisis to make long-term structural changes to their business. They're going to benefit from the recovery period here and enhance their profitability. And so when we look at the demand for narrow-body aircraft right now, it's very significant because of the replacement opportunity that the airlines see. From the airline fleet manager standpoint, they're focused on how can I get the lowest cost per available seat kilometer, and new aircraft are offering them the fastest way to get there. Also, with rising fuel prices, the best natural hedge is around new aircraft, and certainly with the ESG element that we just touched on, that's important for the demand for new aircraft. And so we expect that the manufacturers will want to take advantage of that increased replacement opportunity, increasing their production levels to meet the demand from the airlines. I think the other trend we see continuing is really around startup airlines. A number of airlines have been able to start post-crisis here. Better to start with a blank sheet of paper, build a long-term foundation that's solid. And so we actively evaluate those opportunities as well. And I think, what we saw in the fall and in the summer was, people were willing to travel internationally. The recovery period is not going to be as swift as it is for domestic travel or leisure travel, but international travel did come back. It will come back, and it's just going to be a function of how quickly can we get away from mandatory testing when you enter or leave a country, in terms of stimulating that long haul travel. And so, airlines are battle hardened in terms of how to manage this crisis. We're obviously dealing with Omicron right now. I think we'll look back 3 to 6 months from now and realize this was just another up and down in the recovery, and the airlines and the investors know how to manage through these different variant strains that are inevitably going to come over the next couple of years.
Austin, on that optimistic note, I'd like to thank you on behalf of KPMG and Airline Economics for your time and insights today, and just wish you and Sky all the best in 2022. Cheers.
Thanks, Joe. I appreciate it. You too. Happy holidays.